So we're going to take a look at, the vertical debit spreads. So this is really, the foundation for option spreads or the vertical spreads. So you've got the debit spreads and the credit spreads. We're going to really be covering more the debit spread side of things. These are a little bit easier to trade, easier to kind of jump into, kind of a go-to type of strategy for any type of market. For up markets, down markets, they're not going to do the best in a sideways market, but these are the ones that you can really incorporate into your trading pretty fast. So if you'd like to be able to then look at increasing your probability of profit, reducing your exposure to higher premiums and implied volatility, and also decreasing the negative price impact that negative time decay or theta has on a long option position, then one of the major ways to do this is to start using spreads. So one, big, huge issue with if you're just looking to buy calls or buy puts outright is at times the premiums can be very, very high. And the other big part of the problem that we covered in part one of the course on Saturday is that they also have a big there's a big impact of negative theta and time decay when you're strictly just buying naked calls or outright puts. So in order to lower the exposure, of these high premiums or also that exposure of that major theta decay, the best way to do that is, using spreads. So the vertical debit spread, it's a strategy done with you can either use calls for an upside move or puts for downside move when you're going long these types of vertical spreads. And what it does is it just involves buying one option, either a put or a call, and then selling another one in the same type in expiration, but with a different strike. And we'll go through examples of this. So the vertical spreads are used to, offset that premium cost when buying options, and then also to hedge risk when selling options. Now, the maximum gain or risk, are known from the outset of the trade, and therefore it's going to allow you to be very specific as well with your risk and very, very defined risk. So it's great for your, trading risk management rules. So the vertical debit spreads are a really excellent option strategy, again, when that implied volatility is high, and therefore option premiums are going to be high. So you've got two basic ones. You've got the vertical bull call debit spread. That entails buying a call and then selling another higher strike call that will be lower in price, but that's going to be done to offset some of that premium cost of buying the call. And then you've got the vertical bear put debit spread. So that's a bearish type strategy, which entails buying a put and then selling a lower strike put that will be lower in price to offset some of the premium cost. And these spreads are always done for a debit. So it's going to be, your total risk is your debit paid.